Welcome back. So in today's video, I'll be talking about the stocks that are crashing after their earnings. So in today's video, I'll be covering the two stocks in my portfolio first, which is Meta as well as Microsoft. So I own around 4.5% of my entire portfolio in Meta, and I own around 6.4% of my portfolio in Microsoft. So the first stock that I'll be covering today is Meta. Meta is up around 12% today, and it is currently trading at a 28 times earnings. So for Meta's earnings, they were quite incredible. So revenue went up by 22%, net income actually increased by 36% as well, and the diluted EPS went up by 38%. So you have a mega cap company here that is growing revenues by 20%. I find it incredible how they're doing so. And for this business, this is operating leverage. So for Meta, there's a few things that you need to take note of if you're an investor in the company. So the first one is the amount of money that they're spending on capex. So as you can see here, their cash and cash equivalents dropped from $43 billion to only around $12 billion this year. And their property, plant and equipment, basically their capex, actually increased by the same amount as well. So they're spending a lot of their cash and putting it into basically capex. And once that cash runs out, they're preparing to basically raise debt and to raise equity as well. And from a capital allocation standpoint, this probably isn't a very good idea unless Meta can guarantee that they keep growing like this over the next 10 years. So for Meta, there's another number to take note of as well. So their depreciation as well as their amortization isn't growing as fast as the actual capex number. So the capex number actually increased by around 50% this year, and yet their depreciation is only increasing by around 20%. So there's a discrepancy in terms of the depreciation as well as the capex, which is something to take note of as well. So for Meta, there's a bear thesis even despite this amazing earnings. Your D&A, which is your depreciation and amortization, went up substantially lesser as compared to the capex. This means that the company has a long timeline when it comes to their depreciation. This could mean that the company is understating their expenses and overstating their earnings, but the revenue numbers still look strong. For Meta, this earnings report was just amazing all around. The next stock that I'll be covering is Microsoft. So Microsoft today is up around 4%. It is currently trading at around a 40 times earnings. So for Microsoft, this was their earnings. So revenues increased by 18%, operating income went up by 23%, net income went up by 24%, and diluted EPS went up by 24% as well. So they actually said that cloud and AI is the driving force of the business transformation across every industry and sector, and we're innovating across the tech stack to help customers adapt and grow in this new area. And this year, Azure surpassed $75 billion in revenue, up 34%, driven by growth across all workloads. So Microsoft's earnings look quite amazing as well, and that's why the stock is up around 5% today. And for Microsoft, this is their earnings by segment. So Microsoft Cloud went up by 27%, Microsoft 365 went up by around 16%, and then LinkedIn went up by 9% as well. And this is overall extremely healthy growth from this company. So for Microsoft, they actually increased the prices for the first time in around 12 years. So they increased their prices for Microsoft 365 on an average of around 15%, and that's why you saw the revenues growing at 18%. So not only is the company able to grow volumes almost every single year, the company is also adding on to that with price hikes, which is causing re-acceleration in terms of the growth. So overall, this is actually an amazing report by Microsoft. And for Microsoft, their balance sheet is extremely healthy as well. So their cash and cash equivalents actually went up by around $12 billion, all while the capex went up by around $75 billion. So for Microsoft, it is a lot healthier as compared to Meta. The cash balance is currently still healthy, and for Microsoft, it is overall a very well-run business that's supported by its amazing CEO, which is Satya. So for Microsoft, the earnings were amazing, and the company is almost unbreakable. The company has likely priced in a lot of growth ahead of it already. It is currently trading at a 40 times earnings, and the stock is expensive at this price. I'll continue holding, but trimming is not out of the question. It is a high quality business that will keep compounding in years ahead. But of course, it is trading at a hefty valuation today, at a 40 times earnings. The next stock that I'll be covering today is FICO. So FICO year to date is down around 30%, and just today alone, it is down around 10%. The stock is currently trading at post earnings at around a 55 times earnings. So for FICO, their earnings were quite decent as well. They even increased their guidance. So Score's revenue went up by 34%, software revenue went up by 3%, total revenue went up by 20%, and adjusted EBITDA actually went up by 32% year on year. So the company reported quite amazing earnings, and the stock probably dropped because of valuation concerns. So for FICO, there is another tailwind for this stock as well. So for FICO, it is currently facing a headwind, which could easily be turned into a tailwind as well. So the mortgage market in the US has been weakening over the past few years. As you can see, we sort of peaked out in 2021 when the rates were extremely low. And as soon as the Fed started increasing the rates, we saw a weakening mortgage demand all the way until 2025, where we're seeing some form of rebound again. So for FICO, they mainly increased their revenue through two portions. They increase it through volume as well as through pricing. Currently, volume is coming down, and that's why they're having to increase their prices so aggressively to increase the revenue of the business. But for FICO, if this mortgage portion can basically recover, you could see volume increases over time, which will reduce their dependence on price increases, thereby reducing scrutiny on the company as well. So for FICO, it is a high quality business, maybe slightly too expensive. And for the valuation of the company, assuming a 40 times earnings for this company, which is not cheap by any means, and assuming a 15% EPS growth, I believe the company can grow a lot faster than this. The company today will give around an 8% return. So based on conservative growth estimates here, the company is still slightly overvalued. I'll be looking out for this one and starting into it. If the company provides a decent opportunity over the next few months, I may look to enter into this position. The next stock that I'll be covering today as well is Ferrari. So Ferrari today is down around 11%. It is currently trading at a 43 times earnings. So for Ferrari, it reported decent earnings as well. So Q2 revenue was around 1.8 billion, EBITDA at 709 million, and net profit of around 425 million. So as you can see here, the shipment volumes went up by 0.3%, EBIT went up by 8.1%, EBITDA went up by 5.9%, net revenues went up by 4.4%, diluted EPS went up by 3.9%, and their adjusted free cash flow actually went up by 90% as well. So these are very healthy metrics, especially when the economy is weakening, and especially when we're seeing all the luxury stocks coming down. And overall for Ferrari, it is an amazing business. So for Ferrari, there's one concern with the company. It is basically just the valuation. So the company now is trading at a 44 times earnings, and on a historical basis, this is still slightly elevated. So for Ferrari, if we're able to basically buy this company near 30 times earnings, I think it will be an amazing add to your portfolio. So for this stock, the stock is expensive, but it's a high quality business with an impenetrable moat and a strong brand. It's probably one of the strongest brands out there and almost recession proof as well. In 2020, when we had the COVID period, Ferrari's revenue only dropped by around 8%, and if you were to compare that to all the other luxury companies, Ferrari was the most resilient one of them all. So for Ferrari, it is similar to companies like Multi, like Hermes. All these different companies, they're almost irreplaceable, and that's the power of the brand itself. Next portion, I'll be covering Tokyo Electron stock. So Tokyo Electron is down around 13% today, and is currently trading at around a 20 times earnings. So if you don't know what Tokyo Electron does, it is part of your wafer fab equipment section. Basically what they do is they sell tools related to the creation of your semiconductor. And for Tokyo Electron, they basically reduced their outlook. So they said that there was sluggish demand for general purpose semiconductors for automobile as well as the industry. Capital investment in mature generation equipment in China showed signs of slowing compared to the same period last year. However, there was substantial growth in capital invested in memory and advanced packages for generative AI. So the company is currently now saying that the other portions outside of AI is basically slowing down. The only thing that is driving up demand right now is AI, and that's why the stock actually fell by quite a fair bit. And besides that, they also reported a decline in revenues of around 1%, and operating income went down by 12%, with net income decreasing by 6.6%. And this is another company in your wafer fab equipment section, which is why you're seeing other wafer fab companies like Lam Research, like ASML falling today as well. So it is one that is interesting to look at, especially if you hold companies like ASML, TSMC, as well as Lam Research. Last portion, I'll be covering some questions left in the comments. So the first one, it says thoughts on Disney. So I think Disney is a quality business. They have their theme parks, they have their Disney Plus, they have their patents as well, which they can continually license and basically collect recurring revenues every single year. But for Disney, my problem with the stock itself is basically just the growth of the company and the direction of the company as well. So they've been venturing into the Disney portion, the Disney Plus portion, which is the streaming portion of the business. And they were previously trying to streamline everything towards that portion, basically channel all their resources towards that portion. But currently now, that portion is actually slowing in terms of the growth. So they can't compete with Netflix. Netflix is clearly the winner in the space. The company is no longer very predictable. And for Disney, it is simply a company that I'm not really interested in. The next comment it says, what's your opinion on Marsh McLennan? So this stock is actually an insurance broker. It is similar to your Brown & Brown. They operate in an oligopoly basically. But the problem with all these businesses is they are tied to insurance. Although they don't have to bear the cost, although they don't have to bear the risk of the insurer, they collect the commissions from the insurer itself. When your insurers get into trouble with all the long tail risk associated with their insurance, so that is what we saw with Brown & Brown. That was what they said and what they highlighted in their earnings call. So for this company as well, I think the fundamentals look amazing. But the problem is it is tied to insurance, and insurance is inherently a very hard business to predict. It is a poor business to operate in because of the thin margins. And overall, for these companies, I think they're in a void for now. I hope you guys have found this one useful and invest safe.